The topic we are taking up today is tangible assets. So what are we going to study under tangible non-current assets? See, first of all, tangible is nothing but any asset which has physical substance. Physical substance is nothing but it is existing, you can touch it, you can feel it, and it is firmly, you know, it's a immovable property as well. So immovable properties, land is one of the example, building is one of the example, but here they are using the terminology property, plant and equipment. Okay, property is nothing but land and building, plant is nothing but the factory, equipment is nothing but machinery which can be moved from a place to another place. So some of the assets in this are immovable and some movable, but every asset is physically existing. You can touch those assets, you can feel the assets. Okay, henceforth we call them as tangible non-current assets. Okay, they have physical substance and like you can touch them, you can feel them. And secondly, something when we call as asset, the most important point there is these tangible non-current assets. First of all, tangible is physical substance. That is, it is existing physically. You can touch it, you can feel it. Okay. Point number one is clear. Non-current is it. This particular assets don't are not held for a very short duration of time. The intention is to hold them for a very long period of time. Okay. So hence they are called non-current assets. Some asset, if you want to categorize between current and non-current, current assets, non-current assets. Now, assets are nothing but these are resources which give economic benefits. Probable future economic benefits. So, assets are the resources. Okay, if I have to elaborate, resources which are owned by the shareholders, controlled by the entity. So assets are the resources which are owned by the owners of the company who are nothing but shareholders, controlled by the entity, and on which future probable economic benefits are expected is nothing but asset. Now, coming to this asset, there are two categories, or based upon the holding. That means certain assets are not held for a longer period of time. The intention is to derive economic benefits from them within 1 year. So those are called current assets. So current assets will provide you economic benefits within 1 year span of time. Non-current assets will give you economic benefits in long term, not within 1 year, because the nature of non-current asset is they are illiquid assets. Now, what is illiquid asset? Illiquid assets are nothing but the assets which cannot be converted into cash quickly or which will take long time to convert into cash. Henceforth, they are called illiquid assets. Okay. So again, I'm repeating, non-current assets give economic benefits in long period of time. It cannot give you economic benefits in short duration or within 1 year. It will take long time for you to give the economic benefits. Most probably it will take more than 1 year to give you economic benefits. and current assets can give you economic benefits within a year. Okay. Now, which standard we are going to study today? Let's understand. IAS 16. So accounting standards make your task very simplified. If you follow the standards, there is no chance you will be incurring, you will be, committing any kind of errors, because standards are benchmarks. They give you a very proper guidance with respect to accounting treatment to be given for this particular asset called property, plant, and equipment. That means how you have to, recognize them, how you have to measure them, where and what should be the additional detailing to be given for this particular asset is what IAS 16 will tell you. That means, suppose, suppose property, plant, and equipment, bank loan. I'll ask you a question: which amongst this is an asset? So you will say, sir, this is an asset. But why this is an asset? Why are you recognizing this as an asset? Because, sir, property, plant, and equipment are such resources which are owned by the shareholders of the company, which is controlled by the company itself, and these particular property, plant, and equipment, which is an asset, will give economic benefits in the future. Hence, anything which gives economic benefits is a asset for me. Yes, because this is matching with the definition of an asset. Something which matches with the definition of an asset is definitely recognized as an asset. Okay. So what does IAS 16 do? International Accounting 16 tells you this: any standard which you are going to, study in this particular whole FR paper or subject deals with three things: recognition criteria, measurement basis, disclosure requirements. Again, I'm saying any particular standard you study is going to deal with three things. One is recognition criteria, measurement basis, disclosure requirements. So, as a recognition criteria is nothing but, if you want to show something as assets in your books, it should match with the definition of an asset. That's what I said, definition of an asset. Property, plant, and equipment matches with the definition of an asset? Yes. And it has characteristics to be called as an asset? Yes. It has physical substance? Yes. It can be touched? Yes. Can be felt? Yes. It gives economic benefits? Yes. It gives economic benefits within a year or more than a year? More than a year. So all these conditions and all these characteristics, if something has, definitely we can term that, we can show them as an asset. Yes. That's what the IAS 16 tells. Now we have discussed about the recognition criteria. Let's go down and see what they are saying. So IAS 16 deals with accounting for property, plant, and equipment. How to, what is revaluation, we'll study later. Okay, all this we'll study later. So accounting for PPE, IAS 16, definitions. So property, plant, and equipment, tangible assets that are held for use. So why you want tangible assets? Why you want property? Why you want plant and machinery? Why you want, that's what, plant and machinery equipment? Because you want to use them for production purposes. You want to convert your raw material into finished goods, supply of goods and services. Okay, that means either you will produce, or you have some, you have some vehicles, like truck, lorry, etc. So those also you can use for supply of goods or services. So property, plant and equipment or machinery are held for use in production, or you will be using them for supply of goods and services. I said, truck or lorry or any other asset. And sometimes you may have certain assets which you can use, which you can let out to someone on rental basis and also earn from them, or you can use them for your own use, like you can use any of the building as a office, or you can also, you have a building, you constructed a building and you want to reside in that, you want to use for your residential purposes. See, that's what they are saying. If you are using for your own use also, it's a tangible asset. But basically, any tangible asset you will be using, or you will be employing it for earning economic benefits, is taken as asset here. So any property, plant and equipment I'm speaking about, of course those are tangible assets, okay, are held for use. That means you're using for production purpose. I'm mentioning about factories, plant. You are using them for delivering goods and services like trucks or lorries. You are letting out to someone on rental basis. You are using for your own office purpose. So all these are nothing but tangible assets. Now, so the expectation is to use for long term, that is more than one period. Now, what is cost? Cost is nothing but the price which you paid to buy those assets or to construct those assets. A company A, company A is dealing with a supplier of machinery, that is XYZ Corporation. So company A wants to buy a plant from XYZ Corporation for 10 lakhs. That means they have, XYZ Corporation is quoting them 10 lakhs for a machinery to be supplied to company A. So now company A has to pay how much to XYZ Corporation? 10 lakhs. This is cost for them. So the amount of, so if any company wants to buy an asset and they are paying some money for buying that asset, that means they are incurring cost to buy that asset. That is nothing but the cost of the asset. So cost is nothing but what a company pays to other company to buy a plant and machinery or property, plant and equipment is cost. So I told you right now, either, so what I told, cost is nothing but either you will be purchasing some asset directly from some supplier and making some payment, you are going to incur cost, okay, purchase cost, or you can make that asset yourself in your, like in your in-house facility. That may be called as construction cost. In both the cases you are incurring cost, you're paying, you're going to add all the components of cost, and then you will come to a conclusion that how much in totality it costed you. And here also, like purchase cost is not only one amount, you'll be adding everything. You have gone multiple times to supplier's office, you are negotiating with them, bargaining, at end you come to this, so everything adds up. And here also, everything from raw material to work in progress to finished goods, everything adds up. So construction cost, so both are nothing but cost, okay, you are incurring for that asset. Now, just a second, excuse me. Now, so cost, I have mentioned you what is cost. The amount of cash or cash equivalents paid or the fair value of the other consideration given to acquire an asset at the time of its acquisition or construction. So if you are going to make some payment for that asset, let's say A is making payment, A company is making the payment to XYZ Corporation. So XYZ Corporation is quoting 10 lakhs to A company. That will be equal to the market price of that asset. Okay. That means that will be the price at which XYZ will be selling to every customer. And when you go to market, for you it is cost, for them it is revenue. That means selling price to XYZ Corporation is cost price to A company. That's what they are saying. That's what they are saying. They are saying the net amount which entity expects, the amount of cash or cash equivalents paid or fair value of other consideration, fair value, that is market value. When you buy an asset, it is cost for you. For them, it is selling price. So they always will sell at market price given to acquire asset at time of its acquisition or construction. That means whatever you are spending, if you or any market participant will spend to buy an asset, that would be the market price of that asset. Yes, at which the market or the suppliers or vendors are going to sell. So for you, it is cost. For them, it is selling price. That's what they're saying. Residual value is the scrap value. After obtaining the asset, you're going to use it for long period, and one fine day, a time would come where the asset will uh, you know uh, would be used to its maximum level, and then you can't expect some more efficiency, or you can't expect 100% performance from that asset. It will lose on performance. So if you buy a car today and after 20 years you expect that car to again give you the same performance what it was giving when you bought new, it's not possible. It becomes a scrap. Fair value is market value, as I said you right now, between market participants, the price quoted by the seller to buyer. Depreciation, yes, every asset, if you are going to buy, of course, you're going to use it for long period, and there will be a wear and tear. There will definitely be the technology is going to change in the future. So, because of all these factors, the asset value has to be decreased every year by certain amount, some fixed amount. The accountants will estimate how much amount should be, should be subtracted from the asset value every year uh, to know its actual value after each year or after every passing of the year. Okay, for example, I bought an asset for $100,000, and I know that this asset will be used by me continuously, and there will be wear and tear of this asset, and the asset, uh, the technological advancements which are happening today. Due to technological advancements, the asset is going to become obsolete or outdated asset in the coming future. Henceforth, all these factors, uh, you know uh, definitely it's a common sense. All these factors, as an accountant, I consider to estimate how much I need to deduct from this 1 lakh every year to get its value. Okay. Like if I use this asset, so I expect that every year 10% I'm going to deduct from this. So 10% of 1 lakh is 10,000. So every year we will remove some fixed amount from the asset value, because if it is used continuously, there's a wear and tear. No market participant is going to pay me the same 1 lakh at the end of first year for the same asset. They are also going to question me. See, you have used the asset for 1 year. There has been wear tear. In this 1 year, the technology must have changed. Better machines are available. So why shall we pay you the a premium or same amount what you paid and bought? So we are going to pay you a amount after deducting 10,000. So that's what the market will also decide, and that we have to estimate. So this 10% is rate of depreciation. That is what we estimated. And we are going to deduct the depreciation amount every year from asset value to come to its actual value. So this is historical cost. This is accumulated depreciation. And this is the carrying amount. Please make a note of this. Historical cost, accumulated depreciation, and carrying amount. Okay, so let's go ahead with the further discussion. So depreciable amount is nothing but the depreciable amount of an asset is the historical cost. That means which amount you are depreciating, the historical cost of the asset is depreciated. Okay, that is the depreciable amount. Useful life maybe 5 or 10 years. That also the accountant will estimate. And then the last, they are using the word carrying amount. Carrying amount is nothing but after deducting the accumulated depreciation. That is, let's say first year, let's say the asset is of 1 lakh. So we need to depreciate this, and we are using two methods, straight line methods or diminishing balance method. We can use any of them. The standards permit us. IAS 16 tells you can depreciate the asset either by this method or this method. Okay, anything is possible. Now, so this is 1 lakh. The asset is 1 lakh value it has. And 10% is what we are going to depreciate. Okay. We are looking to depreciate 10% of this asset every year. Straight line is nothing but every year equal amount we will depreciate. So after 5 years, I ask you a question, what will be the value of this asset? So you'll say, sir, every year 10,000 I'm going to deduct, and in 5 years I'm going to deduct 50,000. So the asset value from 1 lakh, if I deduct 50,000, it's going to be 50,000. That is very clear thing. Now, you will, not directly subtract the depreciation amount from this. What you'll do is, you will create an account called accumulated depreciation account. Yeah, this is what, if you have not learned in Indian accounting about accumulated depreciation, you are going to learn in ACCA. It's very simple. It's like a shadow asset account, contra asset account, not shadow, I will say contra asset account. That means this is going to reduce assets value. So what are you going to do? This account is like a reserve where you are going to transfer your depreciation expense. And then how much ever gets accumulated in this account, that whole amount you're going to subtract from this asset value to know the actual value of this asset after 5 years, 3 years, or 2 years, or after how many years you want to know the value of this asset, you can know that after deducting the depreciation of those many years. For example, I'm asking you about 5 years. So first year, 10,000 has been transferred to accumulated depreciation account. Second year also 10,000 has been transferred. Third year, 10,000 has been transferred. Fourth year also 10. Fifth year also 10. So how much got accumulated in this account? 50,000. So this 50,000 I'm going to deduct from 1 lakh. And then this was the original cost or historical cost less accumulated depreciation. And then we have 50,000 as our carrying amount. That's it. See, in recognition criteria, what we discussed, asset is a resource, it should give you economic benefits. Second point was its cost should be measured reliably. What is cost should be measured reliably? The cost of the asset to entity can be measured reliably. That means there should be a cost for it. Otherwise, you can't show them as asset in your books. Okay. So cost should be measured reliably is nothing, but it is generally easy to measure the cost of an asset as the transfer amount or on purchase. That is what was paid for it. Self-constructed assets can also be measured easily. Yeah. See, for example, a company is paying 1 lakh rupees or $100,000 to XYZ Corporation for the machine. This is what XYZ Corporation has quoted to A. Maybe XYZ Corporation has constructed this self-constructed asset. They have constructed this in their factory. So it costed them 1 lakh to construct the whole. It costed them some 90,000 to construct the asset and 10,000 they're adding margin and they're selling maybe. So what is the selling price for XYZ is the cost price for A. So for A, cost can be in two ways: purchase, or if A also constructs in-house, or construction cost. In two ways, A can incur cost. Okay, in two ways, A can either this or this, not both. Now, what we are trying to understand is when you make something or you buy something, a cost is created. But a company has many human resources, like Alex is an employee of the company. Tony is manager. Steve, he is a director. So all these people are paid heavily by the company. These people are the important human resources for company. They create value for company. Can you think company can quote some value for them, or they have a cost? Alex 10 crores. Can someone buy these people? No. Human beings are not for trade. That means there is no cost for all these people. Okay. So even though they are human resources, even though they are biggest assets for the company, but their cost cannot be measured reliably because they are not for sale. Yeah, their services are priced. Their services are, seen in terms of money. For their valuable services, they are paid. Hence, any asset which do not have, for which there is no cost, or we cannot calculate the cost of that, cannot be shown in the books. Henceforth, this statement has come. Cost should be measured reliably. This is done. This is done. Now, see, the next topic we will take in the next session, because from here, if I start this, we have only 1 minute. So probably I'll see if I have time. I'll try to take the class tomorrow. We will enter deeply into the chapter tomorrow. See, after these three chapters, I'm going to take group accounts. So I'm sending you some introduction video regarding group. Okay, fine. I'll not send. First, today, whatever has happened, you start reading that. Okay. So now, first, we have finished recognition criteria. Done. On what basis you are going to recognize something as an asset? It should match the definition of an asset. Hence, we recognize with an asset.